Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, if you're a regular listener to the show, you've probably picked up on the fact that I'm a huge hockey fan. In fact, I've played the game for most of my life. And one of the things that I've learned over the years is that if you just follow the puck, you miss a lot of the game. I was in Washington, D.C. last weekend to visit my daughter, and she is a budding hockey fan. And we went to see the Washington Capitals play the Tampa Bay Lightning. And it was a lot of fun showing her things that were developing on the ice away from the puck, that were impacting the play and where the puck was going. And, you really can't do that watching a hockey game on television. And I think that's one of the reasons that hockey doesn't really translate very well to TV. You can't see the movement of the players without the puck as they set up plays. And, if you're watching TV, obviously the camera focuses right on the puck. So anyway, my point here is don't just focus on the puck, right? Now, you're probably wondering what this has to do with anything, but think about this. Focusing on just the puck happens in a lot of other aspects of life. We get fixated on one thing or one small part of what's going on. Now, it may or may not be the most important thing, but even if it is, and we just watch that one thing, we're still going to miss other important things that are influencing that so-called puck. And if we're doing that, it might cause us to miscalculate the trajectory of the game as it moves forward. For instance, and I'm getting to the point now, if you just fixate on Federal Reserve interest rate policy, which is pretty much what the mainstream media does, you're not going to get the full picture of what is actually going on with Federal Reserve monetary policy. So, what else should we be watching? Well, there are a lot of things, but the thing that I really want to talk about today is the balance sheet. Now, quite frankly, most people have pretty much ignored the balance sheet throughout this entire inflation drama. In fact, a while back, one commentator that I was reading called the balance sheet a sideshow. But I think the sideshow is arguably more important than the main event that everybody is fixated on, like a hockey puck. And by the main event, I mean the trajectory of interest rates, right? Everybody is just obsessed about whether the Fed is going to cut rates more, or are they going to hold rates higher for longer, or could they even possibly raise interest rates? What is the Fed going to do with interest rates? And don't get me wrong, that's important, right? I mean, interest rate policy has a huge impact on the broader economy, especially when you have an economy that is loaded up with debt. So I'm not saying that we shouldn't pay any attention to that at all, but I'm saying we should not just focus on interest rate policy to the exclusion of what's going on with the balance sheet, because when we look at the trajectory of the balance sheet, we get a broader and better sense of what is actually happening on the price inflation front. So before I get into all of that, I want to talk a little bit about the chaos in the gold markets since I last spoke to you fine people. Volatility is the name of the game. We had a couple of big sell-off days that pushed gold all the way down to $2,857 an ounce last Friday, and really broke through that support level that we've kind of seen at $2,900 an ounce. But then we had a rally on Monday and Tuesday that recovered that $2,900 support level. And when gold closed yesterday, we were at $2,929 an ounce. So we've seen this up and down, this volatility, I guess, really is the best word for it. So what's happening? Well, I don't think anybody really knows what's happening, and that is kind of the problem. That's the source of this volatility. Now, of course, tariffs are the big issue right now, and the thing everybody is kind of focused in on in the economy. And after months of posturing, the trade war kicked off in earnest yesterday with tariffs against Canada and Mexico going into effect, and totally unsurprising, retaliatory tariffs. And, I don't want to get into the whole tariff issue again. I've talked about it on the show a couple of times. I've written several articles about it. I'll link to a couple of those on the show notes. But suffice to say, tariffs are causing a lot of chaos in the markets and in the broader global economy, and chaos tends to be bullish for gold because of the safe haven bid. And I think right now a lot of investors are moving capital into safe haven assets to shelter themselves from the volatility and the potential devaluation of equities as the global economy is disrupted by the tariffs. And, no matter what you think about Trump's tariff policy, you can think that it's a good bargaining chip, that he's going to force concessions. That's a reasonable position. But you always have to remember that tariffs are taxes, and they are disruptive to the economy. They are disruptive to supply chains. It is significant. And if the tariffs linger, it's going to become more and more disruptive as we move down the road. And, I think a lot of people are also beginning, and rightly, to worry that this could spark a recession. And, I've been saying for months, if you listen to the show, you know this, I've been talking about the economy is poised for a crash, and it really has nothing to do with the tariffs. This is the result of decades of easy money that have created all kinds of malinvestments and distortions in the economy, and then incentivized all of this debt. We've got this huge debt bubble in the economy. And then they yanked the rug out with higher interest rates. And, the economy isn't built even remotely for this, what I would call a modestly high interest rate environment. It's not that high. And think about this, the Fed has cut rates by a percentage point, despite the fact that price inflation is still sticky. So, we've talked about before on the show, the Fed is walking this tightrope. They simultaneously need to increase interest rates to rein in inflation and lower interest rates because the economy is addicted to this easy money. So the economy is poised for a collapse. And this is historically the precedent, or this is the historical precedent, right? We had the dot-com bubble and it burst. And then we had the housing bubble that was created by, artificially low interest rates and easy money that led to the 2008 financial crisis. So what we have right now, it's like a forest during a drought. All you need is a spark to create a forest fire. And the tariff thing could be the spark that sets everything over the edge. Might not be. I'm not saying that it is. But I think people are starting to worry about that. You're seeing more concern about the likelihood of a recession. I actually saw a chart the other day, and you kind of have this low level of recession expectation, and then over the last 2 or 3 weeks, it has just spiked up. So people are worried about that. And, this was kind of interesting, too. The dollar index plunged on Tuesday with the introduction of the tariffs. So we have dollar weakness creeping in, which is a bit counterintuitive because the conventional wisdom has been that tariffs will drive dollar strength. And, of course, that is somewhat bearish for gold. Dollar strength is because, if you think about it, gold is priced in dollars. It's basically two currencies. So if the dollar is strengthening, the price of gold is going to drop in the dollar. But we're seeing the opposite. We did see the dollar strengthen over the last several weeks with the tariff threat. But then when it actually came to be, we've seen this dollar weakness. The dollar index dropped I think it was over a point yesterday. So, this may be a little bit of the buy the rumor, sell the fact, or people could be considering the fact that even though tariffs might initially cause some dollar strength over the long term, they can actually weaken a currency in the long term, especially if there are aggressive retaliatory tariffs, which we're seeing, and if other countries just start trading with each other and excluding the country that is imposing the tariffs, right? This would lower the need for dollars abroad and therefore boost other currencies. So it's going to be interesting watching how the dollar responds to the trade war that seems to have broken out. But regardless of how it all plays out, the uncertainty around this explains a lot of the volatility in the markets right now and the big swings. not only in gold and silver, but in a lot of things, right? We saw a big sell-off in the stock market yesterday, and the VIX volatility index has gone up by nearly 54% since February 19th. So it's not just volatility in the precious metals markets. The volatility there is reflecting volatility throughout the broader marketplace in the economy. So, of course, the other thing I wanted to touch on, we still have this movement of gold from London to New York due to tariff worries. And I've talked about this on the show several times and, again, written a couple of articles about it over at moneymetals.com/news. And some of our other analysts over there have talked about this as well. And, of course, mainstream analysts blame this dynamic on the threat of tariffs pushing the future price of gold and silver both higher in New York. So people are worried that tariffs are going to raise the price of metal coming into the United States, and they're trying to get ahead of that. They're taking advantage of the way that's driving the futures price up. So you have this discrepancy between the future price in New York and the bullion price in London. So you're seeing that gold move to where they can take advantage of this and make some money. And, there could also be a more fundamental issue at play, the fact that there's a lot more paper gold out there than physical metal. But no matter what's driving this movement of gold across the pond, so to speak, there has certainly been a significant disruption in the gold market, as evidenced by this movement of metal. And just how much gold has shifted over to New York. Well, according to the most recent data, and this was actually as of Friday, COMEX registered gold has increased by nearly 300 tons. That's 9 million ounces. And eligible inventories have swelled by more than 500 tons. And I'll post an article on the show notes that kind of breaks this down more in depth and explains the difference between eligible and registered gold and stuff like that. I don't want to get into that in this show. It'll take forever. But just suffice to say, we've seen like 800 tons of gold move from London to New York over the last several weeks, months. And the last time we saw COMEX inventory spike this quickly was during the early stages of the pandemic. So it is important to understand this is not unprecedented, but it is creating a lot of buzz, I guess, in the gold and silver markets. And if we go over and look at the London vaults, the gold there has certainly dropped, but it's also important to note that gold still remains above the 2022 level in London. So in a nutshell, the premium on the COMEX, the higher price because of the tariff threat or other factors, has created what they call an arbitrage opportunity, with future prices in New York being pushed up by the tariff worries. Big institutions that can quickly move gold between the trading hubs, big banks, are taking advantage of this. And, that's kind of the conventional explanation. Now, there could be there could be more going on than meets the eye. Gold newsletter publisher Brian London believes that the cracks are actually spreading in the global gold market infrastructure. And he said this could have tremendous implications for the price of the metal. And he pointed out that we're also seeing a significant surge in gold being pulled out of COMEX vaults as investors take physical delivery instead of rolling futures contracts over. So if you buy a futures contract, when you get toward the end, you have the option of rolling that over, just getting a new contract, or you can actually take physical delivery of the metal. You can say, hey, I want this metal. So more and more people are actually taking delivery of the metal. They want that physical gold, that physical silver in their hands. They're not just rolling these contracts over. It's not just paper. And if you go back to the comment that I made a few minutes ago about the fact that there's a lot more paper gold than there is physical gold, you can see why this would cause some concern about gold inventories. London wrote, now the flow of gold from the London Bullion Market Association vaults into COMEX could be explained away by the threat of tariffs, but that doesn't explain the coincident surge of deliveries, physical demand from COMEX. So hard to say what's really going on. Probably some combination of both. Regardless of the whys, this movement of gold is definitely something to keep an eye on moving forward, because it could impact the price. And if we start to see shortages of physical metal in these vaults, then things are really going to cut loose, and that would be a very interesting scenario. Okay, so let's take our eyes off of the interest rate puck now and talk about the Fed balance sheet. So most people believe that the Federal Reserve bowed out of the inflation fight and began easing monetary policy in September when it delivered its supersized 50 basis point rate cut. You remember that. That was kind of the beginning of the rate cuts. Now, they talked about it for several months beforehand. They kind of paused hiking, and then they held rates steady for a while, and people started saying, oh, they're going to cut soon, they're going to cut soon. And indeed, in September, they finally delivered the much desired rate cuts. But the fact of the matter is, the Fed began easing monetary policy months earlier when it tapered balance sheet reduction, or what is known as quantitative tightening, in June of 2024. So several months before we got the rate cuts, the Fed was already easing monetary policy. It was already saying, we're not worried about inflation so much. We're going to begin slowing down the pace at which we are shrinking the balance sheet. And I'll get into a second exactly what that means and why it's important. Now, it appears that even with hawkish talk about keeping monetary policy tighter for longer and slowing the pace of interest rate cuts, right now we're hearing that they may not cut rates until September, the central bank may be set to ease monetary policy even further, despite inflation, by further slowing or even ending balance sheet reduction. So it's almost the same scenario, the same setup that we saw last summer. The Fed's talking, but they're actually taking actions that don't necessarily line up with the talk, right? And we're seeing this easing of monetary policy through the balance sheet before we're seeing it in the rate cuts. So what is all of this about? Why does the balance sheet matter? What is the balance sheet? What are we talking about? Well, the balance sheet basically serves as a direct pipeline to the money supply, right? So what happens when the Fed buys assets? It will buy U.S. Treasury bonds and mortgage-backed securities. Those are the two primary assets that it buys. It can buy other things, but those are the two primary things: U.S. bonds, mortgage-backed securities. It buys them, and it does this by creating money out of thin air, right? So what happens is the Fed goes out into the open market and it buys U.S. Treasuries, say it buys a bunch of 10-year Treasuries. It holds those treasuries. It goes on the Fed balance sheet. They're not in the marketplace any longer. And it does that. It basically writes a check. Now, it doesn't have to have any money in its checking account to do that. It can write an infinite amount of checks. That is the essence of money creation. Quantitative easing is what this is called. And this is money creation. It is how the Federal Reserve, quote unquote, prints money. It increases the money supply, right? It's creating money out of thin air, injects it into the economy when it buys these bonds, and then the bonds go on the asset sheet or on the balance sheet. New money gets injected into the financial system first. So the banks get it first, and then ultimately it trickles into the broader economy. And this process, as I already said, is called quantitative easing, or QE. So, before the 2008 financial crisis and the Great Recession, the Federal Reserve balance sheet was just over $900 billion, billion with a B. By the end of the pandemic era, the balance sheet stood at just under $9 trillion, trillion with a T. In other words, the Fed pumped over $8 trillion into the economy in 14 years through quantitative easing. And on the other side of that equation, the Fed's balance sheet expanded. So it's not really so much that what's going on the balance sheet side matters so much. It's just reflecting how much money that the central bank is injecting into the economy. And it's interesting to note that Ben Bernanke was the Federal Reserve chairman during the financial crisis in the early years of the Great Recession. And he's the person that launched the first ever round of quantitative easing at the onset of the Great Recession. And when he did it, he actually went to Congress and he promised that the Federal Reserve was not monetizing the debt. He said the difference between debt monetization and quantitative easing policy was that the central bank was not going to provide a permanent source of financing. He said the treasuries that they were buying would only remain on the Fed's balance sheet temporarily. And he assured Congress that once the crisis was over, the Federal Reserve would sell the bonds it bought during the emergency. And of course, when it sells those bonds, it sucks the money that it created back out of the economy, right? So it creates money out of thin air, injects it by buying the bonds. When it sells the bonds back, the banks give the Federal Reserve money. And so in effect, it soaks money out of the economy. It serves to reduce the money supply. It is the inverse of quantitative easing, quantitative tightening, right? That never happened. There was never any quantitative tightening of any significance after the Great Recession. They tried, they did a little bit in like around 2017, 2018, but they couldn't do it. When the Federal Reserve started to try to shrink the balance sheet back at that time, the markets threw a fit. In fact, if you'll remember, back in September, October of 2018, we had this huge drop in the stock market. People were starting to talk about a recession and the economy was getting shaky. And the Federal Reserve immediately stopped balance sheet reduction. It paused rate cuts, and it immediately went back to quantitative easing in 2019. And I don't think a lot of people remember that or realize that in 2019, before the pandemic, the Federal Reserve was already running what was in effect quantitative easing. It was already back to the easy money policy. And this goes back to what I'm talking about, the situation today. The economy is addicted to this easy money, right? And when the Fed tries to take it away, it throws a fit. And eventually, if the Fed doesn't give it back, the economy is going to collapse. So again, Bernanke promised not monetizing the debt. We're going to reverse this. That never happened. And then, of course, the Fed doubled down when we hit the pandemic, and it expanded the balance sheet by nearly $5 trillion during the pandemic. And what was a little bit different about that was they did it so fast, right? This $5 trillion in QE happened in like 18 months or so. It was unprecedented. I call it QE on steroids. And all of this quantitative easing is, by definition, inflation. Remember, I've talked about this over and over again. Inflation isn't just rising prices. Inflation is an increase in the supply of money and credit. And this is the direct result of Federal Reserve monetary policy. Quantitative easing prints money, expands the expands the money supply by injecting money into the economy. And then interest rate policy incentivizes borrowing. It increases credit, adds debt to the economy, which is also inflationary. Price increases are one of the results of this monetary inflation. Monetary inflation can manifest in a lot of different ways. After the 2008 financial crisis, the inflation really manifested more in asset markets. We saw this huge increase in the stock market. We saw a huge increase in housing and art. There was all these bubbles, and that continued during the QE years of the pandemic. The pandemic was a little different, though, because at the same time the Fed was increasing the money supply, nobody was working. So you had nobody producing anything. So you had more dollars chasing less goods and services, or fewer goods and services. So that manifested itself, unsurprisingly, in price inflation that we experienced over the last several years and are still, in fact, experiencing today. A former Federal Reserve Governor, Kevin Warsh, and that is correct, it's Warsh, W-A-R-S-H. He explained in an op-ed published by the Wall Street Journal last year that there is a direct connection between this money expansion and price inflation. This is what I was just driving at. He said, the monetary base, money supply, is up 60% since the pandemic. Another measure of money, M2, is up 36% in the past 4 years. The inflation surge in the same period, cumulatively about 22%, shouldn't have been a surprise. When he says inflation surge, he really means price inflation surge. I really wish that analysts and media people would make that distinction between monetary inflation and price inflation, because they're two different things. Price inflation is the cause, or one of the causes, or one of the results, of monetary inflation. So we had all of this massive balance sheet expansion starting in 2008, going all the way through the pandemic. The Fed announced a balance sheet reduction plan in March of 2022 when it could no longer convince everybody that price inflation was transitory. Now, the balance sheet reduction plan wasn't exactly ambitious given the amount of inflation it created during the pandemic. If the Fed followed the blueprint, and it didn't, it would have taken 7.8 years for the Fed to shrink its balance sheet back to pre-pandemic levels. That doesn't even account for the trillions added in the wake of the 2008 financial crisis that Ben Bernanke promised was temporary. So the money supply did begin shrinking in April 2022, and this was due to a combination of the quantitative tightening and the interest rate hikes. That first rate hike was in March of 2022. So it basically started balance sheet reduction and and interest rate hikes around the same time. And if we look at the money supply, we'll see that it bottomed in October of 2023 at 20.69 trillion. And since then, since October of 2023, the money supply has crept upward. So in other words, we've been seeing inflation on the rise again, not necessarily price inflation, but actual inflation that will ultimately result in price inflation. That started going up all the way back in October of 2023. As of January, it was at 21.56 trillion. So that's the highest level the M2 money supply has been since January 2022. So we've almost gotten back up to where they were when they started in terms of the money supply. So, in other words, despite all this talk about fighting price inflation, the central bank has been creating monetary inflation, the cause of price inflation, for over a year. So no wonder we're seeing this creeping up of the CPI, right? And price inflation is far from dead. The annual CPI has increased for 4 straight months. Now we'll see what happens for February, but as of January, it had gone up for 4 straight months. So, question, why is the Fed considering slowing down balance sheet reduction now? Right? We're hearing all of this talk about how, we're going to have to keep interest rates higher for longer. We've still got this sticky price inflation. The Fed has been all this hawkish talk. Well, it doesn't make sense in that context to say, we're going to slow down balance sheet reduction even more, or maybe even stop it. Well, according to a Reuters report, many banks had pushed back the expected end of quantitative tightening due to stubborn price inflation. So a lot of the banks, a lot of the analysts had said, you know what? Given that the Fed is going to hold interest rates higher for longer, we think that the Fed is probably not going to pause or slow down balance sheet reduction as soon as we originally thought. But then we go on, and this is from the Reuters report, but there is now no solid consensus as to how the U.S. central bank will proceed with shrinking the holdings over the coming months. So as the Reuters report put it, expectations about the future path of the balance sheet drawdown process have been, this is their word, scrambled. So why has it been scrambled? Well, because the minutes of the January Federal Reserve meeting, quote, showed central bankers concerned about how the effort to shed bonds might collide with dynamics around the federal debt ceiling. Based on the minutes, various policymakers said they were open to pausing or slowing the reduction of Fed-owned Treasury and mortgage bonds to navigate uncertain money market conditions as Congress sorts out government finances and a statutory cap on the federal debt that came back in force last month. So what are they talking about in plain English here? Well, the federal government ran up against the debt ceiling at the beginning of the year. So in effect, this means that the federal government cannot borrow any money at all until Congress raises the debt ceiling. So right now, there's no borrowing going on. So if you go look at the national debt, it's been pretty stable for the last month or so. It fluctuates up or down a little bit based on certain dynamics within the balance sheet, and I'm talking about the national balance sheet. But by and large, right now, we're right at that ceiling, okay? So in order to keep funding federal deficits, because the government's still spending money, right? It can't borrow, but it's still spending. So we're still running big deficits. We had another huge deficit last month. The U.S. Treasury is employing what are known as extraordinary measures. So basically what they do is they pause some funding. They can redeem existing investments and suspend future investments into the Civil Service Retirement Disability Fund, the Postal Service Retiree Health Benefits Funds, and federal employee retirement system savings plans. So basically what they do is they've got assets in these retirement plans that are supposed to be earning money, to pay for these people's retirements. Well, they just raid that. They sell those assets and they use that money to keep the government running. And then they'll have to replace that later, or they should replace it later. Whether they do or not, that remains to be seen. So all in all, you do these extraordinary measures. Most analysts think that the hard debt ceiling, like when the federal government actually has to stop spending money, would be sometime in the summer of 2025. But the current situation is driving what analysts are calling unsettled money market conditions. According to Reuters, quote, this increases the risk the Fed could go too far with liquidity withdrawals, pulling liquidity out of the system, something central bank officials do not want, and which opens the door to a shift in the quantitative tightening process. And an analyst told Reuters that the most likely scenario is a slowdown in balance sheet reduction. So it's already slowed it down once, right? They had a plan, they slowed it down last year, and now they may slow it down even more. So they're going to keep shedding bonds from the balance sheet. They're going to keep soaking up some liquidity, but they're going to slow the process. And he said that freezing quantitative tightening outright would require the central bank to purchase treasuries to keep the balance sheet stable as some bonds mature and roll off. And this, in effect, would be a return to quantitative easing. You would have the Federal Reserve going back into the market and buying bonds. Well, this is not a good scenario because of what's coming up when the government finally deals with the debt ceiling situations. This analyst who talked to Reuters said the communications hurdles stemming from any shift in the pace of quantitative tightening are daunting enough without having to explain the introduction of a temporary new asset purchase program as well. And he's right? If the Fed suddenly starts going back to quantitative easing when we still have price inflation well above 3% officially, and we still have this sticky price inflation going on, and all of a sudden the Federal Reserve is making moves which are incredibly inflationary. How do you explain that away? But Barclays disagrees with this guy. They say the Fed's going to simply end quantitative tightening in September. Done with it. Finished. And again, an end of quantitative tightening, if they want to keep the balance sheet stable, they actually have to go into the market and buy bonds. So I've said for months that the Federal Reserve is going to eventually have to return to quantitative easing to facilitate the federal government's borrowing and spending, right? I've said this before. It's kind of a cliche maybe, but I say that the Federal Reserve is the engine that drives the biggest government in the world. Without the Federal Reserve intervening in the bond market, the federal government would not be able to borrow nearly as much money as it does, and ergo, it would not be able to spend as much money as it does. The Federal Reserve is a facilitator. It's a drug pusher and a facilitator. So here's how it works. When the central bank buys U.S. Treasuries on the open market in QE operations, it monetizes the debt. You heard me use that term when I was talking about Bernanke, monetizing the debt. What does that mean? Well, in effect, quantitative easing turns U.S. government debt, talking about treasury notes and treasury bonds, turns them into cash. So in the process, it creates artificial demand for those bonds, and it drives the price of bonds higher in the open market, right? It's going out in the open market. It's buying bonds. It's taking them out of the market. So that's extra demand. It raises the price, supply and demand, and the interest rates, the yields on bonds are inversely correlated with the price. So when the price of a bond goes up, the yield or the interest rate goes down. So the effect here is it lowers the U.S. government's borrowing costs and enables the U.S. government to borrow more than it otherwise could under normal market conditions. The Fed is sticking its big fat thumb on the bond market. It's facilitating the sale of more bonds. If the Fed is buying some of them, then the U.S. government can issue more at a lower interest rate. So you see how it works. The Fed and the U.S. government are working hand in glove to facilitate big government borrowing and spending. It's always been that way. And this further underscores the catch-22 facing the Federal Reserve. It simultaneously needs to hold rates higher for longer to rein in price inflation, and it needs to cut rates due to the excessive levels of debt and malinvestment in the economy. Obviously, it can't loosen and tighten monetary policy at the same time. And now it faces a similar problem with its balance sheet. It needs to slow down or end quantitative tightening to help the federal government with its borrowing problem, and it simultaneously needs to keep trimming the balance sheet to pull the inflation that it created since 2008 out of the system. Again, can't do both. Federal Reserve Chairman Jerome Powell claims that the central bank doesn't consider the government's fiscal problems when making monetary policy decisions, but it clearly does. And even if it wants to maintain the illusion of central bank independence from government policy, it can't because the two are intertwined, as I said, hand in glove. So, with the possibility of slowing the balance sheet out in the open, this clears the path for the Fed to do just that. And if you've watched the Federal Reserve for any amount of time at all, you'll recognize that they make things public to kind of set up what's going to happen, right? They always signal what's going to happen. The Fed does not like to surprise the markets. So I think this is a signal. I think you're probably going to see balance sheet reduction slow down. And this despite the fact that inflation isn't dead. So the bottom line is the inflation monster is not dead. Don't think it is. And he's about to get another shot in the arm. So what this means to you is that your money is going to be further devalued again. And that means you probably want to have some real money. I'm talking about gold and silver, and now's a good time to do it. In this volatility, you might see some more dips in the price. Buy the dips. If you're interested in getting gold and silver, just watch and buy those dips, because at some point when this all becomes clear, when the bottom falls out of the economy, when the recession manifests, when it becomes even more clear that inflation isn't dead, you're going to continue to see the price of gold go up and up and up. At least that's what I think is going to happen. I mean, I could be wrong. So take what I say with a grain of salt. Do your own research. But if you ask me, if you look at things objectively, you should be bullish gold and silver because it is real money that the government cannot devalue and inflate away. So now is a great time to talk to a money metals, precious metals specialist. All you got to do is call 800-800-1865. Talk to them today. Ask them questions. They can help you figure out, what products are going to work best with your investment strategy. It's worth the talk. And I know a lot of people don't like to talk on the phone these days. If you want to, you can go to moneymetals.com and you can actually chat with a precious metals specialist online. Or if you know what you want, you want some gold bars, you want some silver eagles, whatever it is, you can actually order right online. The process is easy and you'll just walk right through. So do that today. And with that, that is a wrap for this episode of the Money Metals Midweek Memo. Say that 5 times fast. You can get more information about all of the things that I've talked about on the show and more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune in to our Market Wrap podcast that airs on every Friday. You're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Thank you so much for listening to the show. I really do appreciate it. I say this every week, but I mean it. I know there's a lot out there that you can listen to. Thank you for spending a little bit of your time with me. I hope you have a fantastic rest of your week, and I'll be back on here again to talk to you next week.